My next guest says the worst is far from over for the financials, that the sector's problems go beyond subprime. Whitney Tilson with T2 Partners joins me now. Good morning.
Good morning.
So the worst is not over. Let's first get started with Lehman Brothers, since that's the name that's been dominating the headlines. How bad is it?
We think pretty bad. Lehman, it all sort of comes back to not just subprime, but the mortgage crisis, the credit crunch. They've got a lot of illiquid assets on their balance sheets. Most worrisome, they've got $6.5 billion of CDOs. A lot of that is rooted in these defaulting mortgages.
Stay here just one second.
Sure.
We got breaking news for a second. Let me come back. Robert?
Okay, it is official, Alexis. Verizon Wireless to acquire Alltel. They're going to become the largest cellular wireless carrier, if you will, in the U.S. with this purchase there. They're going to acquire the equity of Alltel for approximately $6 billion, including the debt. It's going to be a $28.1 billion total deal. Remember that unit of Goldman Sachs and TPG, the old Texas Pacific Group, bought it out for $27.5 billion, taking it private in November. So again, Verizon is going to buy Alltel for $28.1 billion. This going into agreement, just crossing the wires right now.
All right, Robert, thank you very much. We'll continue to keep you up to date on that story. I do want to turn back to Whitney. I apologize there for interrupting you on that. Obviously, it's been talked about all morning long. But continue to hear your thought process on Lehman as it compares to the whole Bear Stearns fiasco.
Sure. Well, by the way, we are short, full disclosure, Lehman Brothers, not because we think it's going to be the next Bear Stearns, though that possibility can't be ruled out. But mainly, we just think they have a lot of toxic exposures on their balance sheet. They're frantically trying to sell it and shrink their balance sheet, reduce their leverage, but we think at the end of the day they're going to need to raise quite a bit more equity capital to cover the losses of the things like the CDOs on their balance sheet. Last quarter they took $200 million of write-down on $6.5 billion of CDOs, and our best assessment is they probably have $3 to $4 billion of losses there, and they only have reserved $200 million against it. So that's just one example of many things. Toxic exposures that they have that's going to require them to raise a lot more money at highly dilutive terms. That's going to impact the stocks, so that's why we're short it. And
will we see, or do you expect to see, the same kinds of stories as some of the other major broker-dealers who have also had some CDO exposure? Sure.
I mean, the CDO exposure is fairly widespread. What we look for in terms of what we might want to short is what are the companies that are the deniers versus those that have really taken the big write-downs and seem to be putting most of these problems behind them. So Citigroup, Merrill have taken huge write-downs. They've written down their CDOs by 50% or more. And then there's Lehman. They've written down their CDOs by 3%. It's the deniers you want to be shorting, because that's where obviously the market is believing them less than they used to, but there's still some denial there.
Who are the other deniers?
Boy, that's a good one. Well, MBI and AMBAC, two stocks that we've been short for quite a while, but the market's really figured those guys out. The stocks are both down 90% plus over the past year. So we remain short MBIA. We own credit default swaps on AMBAC. We're not sure there's anything left at the end of the day there. We think Lehman survives, but shareholders are probably going to get diluted.
One of the products that you're most concerned about as it relates to some of these financial institutions are option arms. Explain to people what they are and what the two major causes of concern you have for them.
Sure. Well, option arms were mortgages that were given to higher income borrowers, and everyone's been focused just on subprime, but subprime, even at the peak, was less than 14% of all mortgages written. Then the next tier up were the Alt-A mortgages, and those are starting to default at very high rates. But then what nobody's focused on is the so-called prime mortgages, because people had high FICO scores. Well, the worst kind of prime mortgages were these option arms, and it means that someone would borrow $600,000 to buy a $600,000 house, and instead of paying, let's say, an 8% interest rate, interest only on that, the word option in option arm means that they don't have to pay 8.5% interest only. They could pay 1.5% or 2% for the first 5 years, and as long as they're doing that, the difference between the actual interest rate on the loan, 8%, and what they're paying, 2%, if they keep paying 2%, the interest rate difference gets added to the balance of the mortgage. So you have a horrible dynamic going on here where the loan balance is going up because people are only paying the very low teaser rate, but the home prices are declining. Many of these option arms were written, the majority were written in California and Florida, where you're seeing 25% home price declines. So now you've got homeowners with $700,000 mortgage on a home that's only worth $400,000 or $450,000, and those mortgages are likely to default.
Those ones that are likely to default, you and I had this conversation that people are becoming more comfortable with foreclosures, bankruptcies. We were talking about Ed McMahon. Which ones, though, are the companies right now in the marketplace that we should be aware of as it relates to these option arms?
Sure. Well, one, again, full disclosure that we are still short despite a big decline in its stock price is Washington Mutual. They have almost a quarter of their entire mortgage exposure, nearly $60 billion, is in option arms. And these things are structured. People aren't really focused on the risk here for two reasons. One is the borrowers had high FICO scores, but when your payment goes from the teaser rate of $900 a month to, let's say, $3,300 a month, huge payment shock when these things reset. I don't care how much money you're making, you're going to be in trouble. The second reason is these are structured for the first 5 years. You can keep paying that 1.5–2%. So it's almost impossible for these mortgages to default because of the way they're structured in the first 5 years. But we think once these things start to reset, they're going to be big, big losses.
All right, Whitney Tilson, really fascinating. And I noticed the other names you talked about, WAMU, Countrywide, and Wachovia. We've got to wrap it up, but I hope you'll come back and join us again. It's
be happy to.
Another big problem that I don't like to see in the financial sector. All right, thanks so much.